Welcome back here with Money, and we are discussing the outlook for the mutual fund sector and, of course, your investments in these mutual funds with Mr. Nimesh Shah, MD and CEO of ICICI Prudential Asset Management. Nimesh, now debt is a word that people are increasingly thinking about because they now know that fixed deposits aren't giving them too much. We've been getting lots of queries, by the way, on the show as well. Small savings schemes, we've seen the rates go down there as well. So suddenly people are thinking, I do want a little bit of protection, so therefore I want an element of debt in my portfolio. Can I do better than an FD? Can I do better than, let's say, a NSE certificate? So what do debt mutual funds have to offer to a lot of retail investors that are looking for options now?
See, there are two ways that one makes money out of debt funds. One is that you invest for a very long period of time. See what happens when interest rates come down, your bond value goes up. And higher the duration, higher the bond's value goes up. So last year when I came on your show,
you were talking about duration funds.
I said please invest in duration funds, go for maximum duration, go for long-term durations because we expected interest rates to come down. Right? This has happened. It happened late, but it happened. So we are very happy that that call has gone right. And investors have made serious money in debt funds when they invested for long durations. But now that interest rates have already come down and there is limited scope of interest rates going down further, we don't believe that this is the time to invest in very long duration funds.
Okay.
The kind of debt funds that I would advocate in 2016 would be either the short-term funds that we have got. A lot of short-term funds are there in the market, ICICI Prudential short-term fund or any other fund.
And what kind of instruments or paper do these funds typically invest in?
It would be in various short-term bonds or short-term government papers or short-term bank papers. It's a mix of all that one invests in. But second and the more interesting one which I feel now is there is a segment called as corporate bond funds. Right, where we choose good corporates where to invest the money. So we have got two funds, ICICI Prudential Regular Saving Fund and ICICI Prudential Corporate Bond Fund. So you are typically investing in AA rated corporates. Corporate bond fund would typically invest in a AA rated corporates. So you get in accrual income. Accrual is what you accrue every month, every quarter. So if you are we are taking debentures of good corporates and they pay us interest every quarter or every 6 months or every 1 year, which is passed on to the investor. So instead of you directly taking those corporate bonds, and if you stay in these funds for 3 years, you get taxation benefit of indexation. So the tax that you pay will be very less. So from tax adjusted point of view, it will favor very well vis-a-vis the traditional instruments that people invest in for returns.
Now, what are the risk elements that an investor needs to keep in mind when he's thinking of debt? And the reason I ask this is that in the last year itself, we've seen cases where a certain corporate was downgraded by a rating agency, and then, you know, the kind of exposure a certain fund house had and the haircuts that had to be taken, etc. So what are the red flags or the caveats that one must keep in mind?
If the downgrades happen, then you lose that much money, right? If you want to get out in an immediate basis, then you can lose money because the corporate has got downgraded, the value of the bond goes down.
So your principal is not protected. That's something that an investor should keep in mind.
That is very clear. Anything related to mutual funds, there is
including debt mutual funds, of course.
Debt mutual funds, equity mutual funds, hybrid funds, whatever be of mutual funds. See, we don't have that amount of capital. Another risk in that is that if the credit call goes wrong and the instrument becomes a default, then the valuations will come down rapidly.
Which is typically
because India is not a very liquid market for junk bonds.
Right.
So it is not possible to sell once. So you should be conscious that the risk management practices of that fund house are good enough, and if there is an accident, they will be able to manage the situation better. So what is done by mutual funds to do that? The amount the investors look at what is the concentration in one single company. What is mutual fund all about? Mutual fund all is about spreading the risk. In debt funds, one should be cautious whether there is a concentration risk on it. What percentage of the fund they invest in one particular company. So what we do as a fund house, we try and reduce concentration risk as much as possible, that we don't concentrate a lot of money in one company. So we spread our risks amongst various companies.
Okay, so typically if you're talking about, let's say, accrual funds or even short-term funds, which is what you're recommending for 2016, a fund like that would be holding a portfolio of debt across how many different companies, if you're talking about a corporate fund?
It can be 40 to 50 companies.
Okay, so it's a pretty diversified basket.
So you should invest typically 2 to 3% in one company.
Okay. Okay.
So that's the kind of risk mitigation that you do.
Between these two categories that you've recommended, which one might give better returns between short-term funds and accrual funds?
I feel since it's a 3-year call, I would invest my money today in accrual funds.
Okay. So finally, as we come down to the last bits of the conversation, your thoughts about the distribution model as well, and whether we can expect any changes in the manner in which people are buying mutual funds. Are you expecting any kind of changes in the landscape there?
See, one thing is very clear, that mutual funds are people don't wake up in the morning and say that today I have to go and invest, right? Mutual funds are essentially sold. They are not bought. So the distributors in this country have done a fantastic job of wherever we are today is because the distributors across the country, we have got distribution in 200 towns of India or more. And we have got fantastic support, and they have developed a business over the years. So I think they have done a very good job of setting up that business, and I believe this business will continue because the product is very pure. So it is not a it is a push product. It has to be gone and explained to people that you should do this, do not put in traditional instruments, put on this. So the advisor is always required to recommend the right products. A part of the business, today 90% of the business anyway comes through distributors. So I think they are a very important segment in the whole thing.
Okay, so I'm going to come back to the beginning of the conversation, and you said it's a 3-year call in terms of investing in mutual funds, whether it's debt or equity. So now, if we're talking about that equity call, and if someone continues to stay invested for at least another 2 years, if not longer, what is a realistic return or rate of return that he or she can hope to generate?
It's never possible to say that, and I will never say that because we ourselves don't know what can come up. But I believe either 2017 or 2018, one of the 2 years will be a great year for returns in the equity markets.
Well, that's a good note to end on. Thank you so much for joining in and answering and demystifying a lot that has to do with mutual funds. Thanks for being with us on this show. That's it on this week's episode of Money, Money, Money. Thank you for watching. Of course, keep writing into us. Our Twitter handle as well as our email ID is on the screen. See you again next week.